All right. Happy Monday, everybody. Welcome to another weekly edition of our commitment to you, which is really going through, it's for self-employed individuals and all 1099s, both real estate and non-real estate related. We here at the AE Real Estate Group are very appreciative of all of our vendors. We're going to be doing these really for our own internal teams, our agents, our contractors, our vendors. When someone decided, you know what, it'd be better if we opened it up to the public. So that's why we appreciate each and every one of you coming on here with us every single week, Mondays at 3, while we go through COVID quarantine. And as we talk to our teams this morning, I just wanted to share with you guys one thing that we're trying to put a focus on is to, as you're in this quarantine phase, what are you doing to better yourself or your business as we go through this quarantine? Because this is not just about doom and gloom and medical scares and wellness scares and that sort of thing. It's really about you guys. Everyone here has an opportunity to better themselves or their businesses in some way. So very happy to introduce to you guys now. You already know Matt, who's going to be going through his presentation on 2008 versus 2020. Don't panic, here's why. And we also have, I think, Ron and Anthony will be joining us to go over their updates on the CARES Act and the incentives for the 1099s employees as we keep going through. So I will turn it over. Matt and team, thanks so much for doing this, for hosting.
Awesome. So great to be with you guys. Happy Monday to everybody. Hope everybody had a great week, or great weekend, I should say, that we were able to get out and enjoy the weather in some way, shape, or form while still maintaining some socially distancing guidelines as well. Let's get right into it. Got a little bit of a lot, I don't want to say a lot to cover, because I always think everybody says that when they do one of these things. But when we were talking about last week, kind of what we wanted to talk about with this particular topic and this particular week, there's a lot of noise out there about that this is 2008 all over again. And I thought it would be a good opportunity to really get into the numbers and really talk about why this isn't 2008 and why nobody should be panicking that we're looking at 2008. So if people have any questions, comments, anything that they'd like to share, by all means, feel free as we're going through this. There's going to be a lot of data thrown at you guys with this. So if there's any questions, comments, please, by all means, throw them in the comments and we will be happy to get to them, not only at this presentation as well, but if you have questions that you want to get in already for Anthony and Ron, by all means, get them in and we will get them addressed. So I want to take a step back and go back to 2008, really 2007, 6, and 05, and talk about how we got to the housing economy collapse in 2008. And it really began when Wall Street started to sell a product called mortgage-backed securities. Now, if anybody's ever read the book Too Big to Fail or The Big Short, or even seen the movie The Big Short, you'll know a little bit about what we're talking about here. What mortgage-backed securities are was that they're a product that mortgages got pieced together. They were compiled. Wall Street banks loved to buy them. They were relatively secured assets because, quite frankly, at that point in time, everybody was paying their mortgages, so there wasn't a huge issue, and the asset was relatively secured. Mortgage-backed securities became so incredibly popular by Wall Street, they needed more loans to bundle up. So what happened? Lenders pushed back and decided to accept more loans as demands to buy the loans existed at record levels. Thereby, they created more packages for people with less than stellar credit and potential riskier borrowers. So a little bit of a domino created effect. The long accepted fact of being a homeowner was that you needed a 620 credit score with 20% down. But at the turn of the last century, 2000 and starting in really 2003, 2004, and 05, that started to turn. Credit scores were taken with 500 and there needed to be no money down. There was no job, there was what were called ninja loans, no income and no job approval, and mortgages were still being provided. Consumers then had a false narrative. If the banker at my local bank was willing to give me a loan, I therefore must have been able to afford the loan, and so that's good for me. So what am I going to go ahead and do? I'm going to go out and I'm going to go ahead and buy that house. And home ownership reached its record levels in about 06, 07.
Hey, Matt, I wouldn't
Yeah.
interrupt you, except it's pretty important. I made you the host here,
Yeah.
but apparently this meeting did not start recording, and it takes you to record it. Oh, is it recording? You are recording it now. Who's
Okay.
recording it?
I'm not. I don't know if I am.
Gotcha. All right, never mind. If you are Brianna, if you can make sure it's being recorded so we can post it on the social media. We can't do co-hosts anymore. I don't know why.
I don't
But
think I have access to
yeah,
this
it's only you,
recording.
Matt. It's not letting me do
Whoever
it either.
started the meeting. Yeah.
Oh, let me see if I can figure out how to do that then.
Should be a record button at the
Nope,
bottom
it says
of your
pause recording. So clearly we are recording.
Okay, never mind. I will back off.
All right. So what was I saying? Oh, so banks knew what they were doing. The mortgage products that they were buying weren't great. So they created an insurance product against this. Now, this is what the movie The Big Short is basically based off of. Banks were shuffling these bad loans that they were issuing to mortgage people, but there were companies out there, one particular called AIG, that was issuing insurance against these bad mortgages, basically saying that if an underlying mortgage, i.e., if I'm a borrower of a home and I stop paying my mortgage, the bank would not be on the hook for it. The insurance company would. If you can start to see, there's a domino effect coming. This is where the term credit default swap came into play. And if you're trying to remember all these credit default swaps and mortgage-backed securities, not the purpose of this presentation, but just kind of giving everybody a sense of if you hear these terms again, this is where we're coming from. Banks moved all of their risk off their books so they can continue to make bad loans. But then the unexpected thing happened, whereas housing prices started to drop as demand for these homes saw its first drop in years because, quite frankly, there was nobody left to buy homes. Everybody who wanted to buy a home had a home. Therefore, prices start to dry up. These mortgage products that had been created in the 05, 06, and 07 run-up, which were called adjustable rate mortgages, that had been so hot and popular, had seen their teaser rates dry up and expire. So people who had their cheap mortgages taken out all of a sudden saw their rates go up. Homeowners couldn't afford those payments, so they began to default. It wasn't necessarily that they knew or were given bad loans. Yes, they were. But quite frankly, because that there were no job and no income verification, nobody bothered to think about what would happen in 3 or 4 years down the line when all of a sudden the rates went up and more than doubled and quadrupled in some point in times, and people had much higher mortgage payments to make. So where did that leave us? Mortgage-backed securities began to fail. All those mortgages that had been bundled up that banks were gobbling up left and right all failed because people weren't paying their mortgages. Foreclosures went through the roof. Those insurance companies, which had taken all the risk on from the banks that had issued the loans, all of a sudden had massive problems and started to fail, and in many of them actually went bankrupt. So then the banks were left with the only thing that they could do, which was to write those bad loans off, and many of them did on one particular day, which was the worst housing bubble burst, which is when companies like Bear Stearns and Lehman Brothers all went under on the same day. That in turn had a domino effect. Banks lost equity and didn't have equity to dry up, so in turn the credit market dried up. And all of a sudden, we are in a full-fledged crisis, not just on the housing front, but on the economic front as well. So that's 2008. So let's talk about what got it back on track. Well, credible loans were given to qualified buyers. Yes, that's where the term qualified buyers came back into more prominence. Number two, there was the establishment called the TPP program, in which case a lot of banks who didn't really want the loans had no choice but were bailed out by the government to give an influx of credit to potential clients to then borrow on. That was actually huge. Number three, there was the revitalization of the overall economy. With the influx of credit, people were able to apply for more loans. They were able to take out lines of credit on their business. They were able to reinvest in their business, and things started to come back in a more positive way. But most importantly, consumer confidence picked back up, and people felt secure with their money again, and they weren't concerned about banks all of a sudden being closed due to lack of money available and that there weren't any more runs on the banks. So where are we in 2020? let's fast forward to this point in time. We'll come back to 2008 in a few moments, but let's talk about where we were in 2020. The economy was roaring. We had seen record stock prices. Now, people are going to argue that in terms of inflation, and when you factor in, yes, things were probably just as good in the middle part of the 1980s. However, taking things as they are in current dollars and cents, 2020 was still record highs. Low unemployment, it says employment here, low unemployment. In fact, we were actually bordering on full employment. Now, what does that mean? It basically means that people who were looking for a job were able to find a job. What you have to understand about the unemployment numbers that you see is there's always going to be some level of unemployment because, quite frankly, there are people who aren't looking for jobs at this point in time and are collecting unemployment. Kind of a problem with the way that we judge unemployment in this country, but fact of the matter is that we do take into account that people who just, quite frankly, aren't looking for a job at this point in time and aren't ready to look for a job, and they are collecting unemployment benefits. However, in 2019 and the early part of 2020, our numbers for unemployment were so low, it was basically full employment. That's great. There were also strong mortgage rates. Rates were considered relatively low. Money wasn't too expensive, but it wasn't cheap. It was kind of in that happy medium where everybody who was looking for a loan was able to get one. And there were available sources of credit and capital. There were actually record numbers of borrowers, and there were a high number of people willing to provide loans through all different spectrums, whether it be hard money, private money, soft money, all these different types of money. There were a record number of people who were willing to provide loans to those people who were looking for it. In fact, there were several companies that were created in the last 5 years solely for the purpose of providing people loans to whether it be their companies or themselves privately. All these things are positive signs. Things were looking great. We were getting ready to hit the spring market and things were looking relatively upbeat, but then all of a sudden March 11th happened. Now, what happened on March 11th, you might ask? Well, there were two things, and two things in particular. Number one, Tom Hanks, yes, Tom Hanks, the actor, announced that he had been diagnosed and proven to be positive for coronavirus. Number two, about 45 minutes later, Rudy Gobert of the Utah Jazz was found to be tested positive for COVID-19. And all of a sudden, the world seemed to come to a complete and utter halt. Negative news hit. Negative news was abound. All of a sudden, people started to realize maybe this is a big deal and maybe this isn't just going to be some isolated incident. And when there were a few major players that started to announce that they were COVID-19, all of a sudden things started to take notice, sanctions went into place, and the snowball effect happens from there. Simply put, negativity begets negativity, period, end of story. Things felt different. We acted differently. Things had to be happening. We took action to go ahead and take to make sure that this didn't spiral into where we are. We self-quarantined for reasons understandably so. We social distanced for reasons understandably so. Do we necessarily like it? Probably not. Most of the time, no. It doesn't feel great. We can't go into our office. We can't interact with people. We can't go to the grocery store without having to stand outside in the line for however long. We can't go to Home Depot without standing in the line. We've had to make sacrifices in the current time to make sure that this thing gets dealt with in a manner that makes it so fitting in times that are asked upon us. But is this 2008? There have been a lot of people out there who have wanted to scream and shoot and shout at the mountain that this is exactly like what 2008 was. Woe is me, the sky is falling, and problems are going to be abound. The housing market's going to go in the toilet, and it's going to be a worst nightmare of all time. Hold on. Let's take this from a factual standpoint in time, and let's look at the numbers and the data to understand where exactly we are. I heard a great quote earlier on this past week that I wanted to share with everybody, and that says, extraordinary claims requires extraordinary evidence. So I want to make sure that we back this up in ways that made sense to everybody. And the first thing I want to show is this. For those of you who are looking at it and have the ability to, and if not, and you're, for whatever reason, you're out doing a couple other things, I don't take it personally, I understand. You'll come back, you'll be able to come back and watch the replay. But what's on your screen right now is the month supply index for the overall housing market, not just in the United States, or not just here, Boston, but nationally. And what I want you folks to pay close attention to is I've drawn a line about 6.5 months. And 6.5 months is the deciding factor between a buyer's market on the top of that line and a seller's market below that line. Now take a look at where we are. You'll see in 2007, 2006, 2007, and 2008, we were in a massive buyer's market. Inventories were at an all-time high. We were over a year inventory for supply of houses in the market in the United States. Think about that for a second. There was over 1 year's supply of homes available. That's crazy. Then things kind of fell off. By the turn of the last decade in 2012 or 2010, we actually dipped into a seller's market for the first time in over 5 years, almost 6 years since the last time it had been a seller's market. Then we kind of picked back up very quickly and it became a buyer's market. And then it fell off a cliff around 2012 and hasn't picked back up with the exception of a very small blimp in 2018, 2017, where it was a buyer's market, but very, very, very briefly. And we haven't really gone back since, and it doesn't look like that's going to change anytime soon. There's 2 times I want to focus on and call people's attention to. The last time we had a massive economic crisis was in 1987 when Black Monday hit and the economy just absolutely fell off a cliff. And you'll notice then, as you can kind of see it on the grid, that it was a seller's market or a buyer's market at that point in time too, but nowhere near the radical point in time that it was in 2005, 2006, and 2007. You can also see going way back into the early parts of the 1980s as well, when there was a little bit of a economic crisis as well. It was a seller's market, but it picked right back up, or a buyer's market, but it picked right back up into a seller's market. And then of course you see the oil crisis in the early part of the 80s and then in the 70s as well. So all the economic problems in time have created buyer's markets, but that's not where we are right now. We're still in the midst of a seller's market. Continuing on, the next graph I want to show you is the Mortgage Credit Availability Index. Now, basically what this means is it means how easy it is to get a mortgage. And again, I'll call your attention to 2005, 2006, in particular, the summer parts of 2005 and the summer parts of 2006. And you'll notice that it was an all-time record high. We were almost at 900, which is off the charts high. To give people a comparison, right now, we are barely at 200. We are at 152.1 in January of this past year, January of 2020. Now, yes, it has been ticking up higher over the last, say, 5 or 6 years, but it is by no means to the level that we were in even 2004 and 2005. Starting in 2004, we were just starting to understand what it was and started to track it. 2006 hits, we were at an all-time record high, and we'll probably never get that high again when we were close to being around 900. So keep that in mind. Mortgage and Credibility Index shows that it's still hard to get a mortgage. You still have to be a qualified buyer. In fact, we've actually dipped off a little bit in the last 6 or 7 months. We actually dipped from July of 2019. We've actually even seen a little bit of a dip from that point in time. So keep that in mind as well. This graph in particular, I find fascinating. The total equity of cashed out from people's homes, or total home equity cashed out. Take a look at what happened in 2005, 6, and 7. We had $824 billion in those 3 years cashed out of people's homes. Look where we are in the last 3 years, 2007, 18, and 19. We've only had $232 billion cashed out in those 3 years compared to 2007, where we had $240 billion cashed out. So the last 3 years, in the run up to the 2008 housing crisis, we haven't even hit that number in the last 3 years combined. And if you're wondering where the peak was, take a look at in 2006, 321 billion cashed out. People were really taking cash out of their homes to buy more homes, to buy boats, to buy RVs, to go traveling, education, medical expenses, all this, that, and the other. The thing that people are taking their cash out of their homes for right now, if people are curious, studies and numericals show that this is all for medical expenses and education for their children. This isn't to go out and buy second and third homes or go out and buy that boat. This is for what people are deeming necessary expenses. Now, if you're wondering where all this data comes from, something radical happened last week, which was the census information was all released. So all this information is compiled from the US Census that just released its information. If you really want to get into it, spend some time, you can go on the US Census Bureau and read all this information. One of the other interesting trends that we're seeing as well, and this comes from the National Association for Housing Bureau, which basically shows that the number of home ownership has increased by 2.6 million, while the number of renting households declined by about 600,000 or 0.6 million. And the number of homeowner households has been climbing since the third quarter of 2015, while the renter households has been on a downward trend. And this is a trend that's only continuing in this point in time now, as the demand for apartments and high rises has basically flown through the floor and sees no end in sight, as people are realizing they may not want to live directly on top of one another. And single family home ownership and single family home rentership has only gone up in demand in the last 6 months. This is something that's going to continue. In simplified terms, this has been a trend, and what we are dealing with right now is an external health crisis that has already increased this trend, as I said, as the demand for available rental apartments has gone down and doesn't see any end in sight to necessarily be stopping. Now, these are a lot of graphs that we'll show quickly over the next couple of slides here, but this shows the monthly rent or monthly median rent. Again, this is all from the Census Bureau. If you take a look in 2008, and what I love about this graph, it shows the US nationally, and then it breaks it up by region, so we can actually see something that's correlating to us in particular here in the Boston area and the Northeast, where we can kind of see the rate for rent over the last couple of years. And now what's imperative to look at here is if you look at just these first 4 years, 08, 09, 2010, and 2011, you'll actually see that the numbers increased, then decreased. So it went up from 2008 to 09, then down in 2010, and then down again in 2011. Nationally, and then you take a look at it in the Northeast, well, the Northeast is just ridiculous in terms of its rent. It's only going to go up, but it didn't go up as necessarily high as people would expect it to go. As you'll see in 2011, it was $879. Let's take a look at in 2012. It was $886, then $945, then $962, then $963 in 2015, then 2016, $995, and then we finally hit the $1,000 threshold, $1,134, $1,209, $1,215, and then 2020, the data shows it was, if you look down here in the bottom, 1,357 median rent in 2020. Now, this is just the first quarter, so it's a little bit hard to see, and we'll be curious to see what this bears out at the end of the year. But what I did in this particular graph is this is 2008 in the top corner, 2020 in the bottom corner, and take a look at where we are in terms of rent. If you had told me that the 12 years there would be that little of an increase from the national rent in the Northeast rent, take out the Midwest and the South, there isn't a ton of demand, though the South has seen a radical rise in terms of its population growth. The Census Bureau bears that number out. The South is the one segment of the U.S. population where it's grown the most over the last year over year, whereas the Midwest and the West has actually lost the most people year over year in terms of its population. So fascinating demographics there to look at. But you can take a look at the demand for rent is still increasing. But what's happening about this is people are paying more for their rent. They're getting to the point in time, and this is just the median. This isn't the high, this isn't the low, this is the median number. So people are paying a lot of money in rent at this point in time. $1,357, that's the median number in the Northeast. That's a lot of people's mortgage payments for their home ownership they've had as well. So keep that in mind as well. This is a graph that I think is fascinating because it shows, this is directly pulled from the company Showing Time. Now, its blue line indicates what it has actually been, its relative line of median expectation. And this is basically showing over its time in just the Northeast, the number of requests that it's seen through its company for people to go look at houses. And you'll see in the month of January, and we'll touch on this in a moment with another graph in here in the Northeast, that it's Showing Time we're going up and up and up. It was seeing a radical demand for people to take a look at homes and go see homes and go view homes. Then March 11th hit. and it basically fell off its cliff. That is a downward trajectory that we don't like to see very often. Now, what are we seeing here in the month of April, where things are starting to pick back up a little bit? And maybe as we hit in the month of May, when Showing Time will release its data for the month of May, it is actually forecasting it to be back into its relative line of normalcy. So we'll see what that bears out, but it still shows that people are looking to go ahead and buy a home, or at least be looking at their home. Now, this is something I also want to pay close attention to. This is the V-shaped recovery that the 4 major institutional banking companies in the United States do believe that we are in line for. What we actually just had last week was the announcement of the GDP number for the United States in its fiscal quarter 1, which was negative 4.8%, which is the first time it's been a negative GDP number in the United States in the last 15 years. So that's a real pivotal number to look at. We're negative right now. But all 4 major institutions, Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo, are all saying that we are going to see a V-shaped recovery. What that means is that we've hit the bottom, and either in quarter Q3 or Q4, we are going to see a positive GDP number come back out, which is the bellwether for how we are doing as a national economy. If it's positive GDP, it means people are putting money back into it. It means that as companies are producing more things, it's all signs of positive, and that we are in sign of a V-shaped recovery. There's been a lot of speculation that it's going to be a check mark, a Nike swoosh, a W, an L shape, whatever the number is. All 4 major economists, and keep this in mind, Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo, are all saying this is going to be a V-shaped recovery either in Q3 or Q4. You can see on the screen, if you're looking at the screen, where they're kind of forecasting with the different colors what they're thinking things are going to look like. There's a couple people at Wells Fargo who still say it's going to be negative in Q3, but in Q4 it will turn back positive. Goldman Sachs has been kind of that intermediate. JP Morgan has said that things are going to normalize, but they're going to kind of hold form. And Morgan Stanley says that things are going to ramp back up right away as soon as any positive sign comes back, and then it's going to tail back off a little bit in Q4. Take that with a grain of salt. I am personally of the belief that it will be a V-shaped recovery. Here's the first line of data that I really wanted people to see. This is the 2008 Boston, or the 2008 Massachusetts numbers for what happened in terms of the housing market in 2008. And this is the entire inventory, essentially, for what the 2008 housing market looked like. And I actually think this might be 2005. So let's take a look at 2005, for example, and you can see, because I wanted, or 2006, and you can see what was happening just before the crash, as the crash, and where we are in 2019 and where we are up until this point in time. Take a look at the bottom here. You'll see 47,368 properties were sold in this particular calendar year. There were 87 days on the market, 59 days till offer, and the average price point was $443,000 with a median price point of $362 even. Let's go forward to 2008. You see the demand fall off there. 34,664 homes sold with an average days on market of 136 days. Ouch. Imagine trying to be a seller who is needing of selling your home at that point in time and having it sit for over 4 months. That's going to hurt. Average price point was $391. Median price was $310. Compare that to just 2 years ago when we were looking at an average sales price of $434 and a median price of $362. There is a lot of hurt on those numbers alone, but as you can see, less houses sold comparatively. 47,000 homes compared to 34,000 homes, so about 13,000 less homes sold. Let's fast forward now to 2019. 53,227 homes were sold last year. Average day on market was 59. Average price $516. Median price $415. Now again, this is comparatively just to the state of Massachusetts. This isn't nationally. I wanted to go ahead and give folks a common sense of where we were in terms of the localized numbers and give you a little bit of a dose of that as well. So you're taking a look at these numbers and you're kind of wondering, well, what exactly does that mean? Well, let's take a look at where we are at 2020 up until this point in time, and you'll see 12,180 homes with an average day on market of 68, with an average price of 524 and a median price of 420,000. Folks, what we're trying to show here is this is an inventory problem. Inventories have not picked up. We are still in a seller's market. Inventories have never been where they were and will probably never be again where they were at this stage in 2006 with 47,368 homes on the market. That is a ridiculous number at that point in time. Now, sure, people are going to say that if we fast forward back to 2019, it was 53,227. But you also got to remember that there have been more homes that were built at that point in time over the course of those, call it 13 years. So there's more inventory particularly available that you could pull from, but sellers still aren't necessarily thinking about selling their home. So right now we are faced with a difficult problem on our hands where inventories are at a record low and we still don't have any end in sight. So let's take the numbers and take a look at this a little bit deeper. And this is pulled from the Warren Group, which is based here in Boston. The median sales price, and this is just for the month of March now that we're talking about, and compared it to 2019, where it was 402,000, which was up from 2019's price of 377. That's up 6.3%. We had 8,374 single-family homes available, which was down 22% from March of 2019. But let's take a look at that compared to the months previous year over year. February was down 20%. January down 22%. December down 20%. All those inventories show that houses weren't available even before we hit COVID-19. COVID-19, remember, hit in March of this past year. Yet inventories for the 3 months previous, going all the way back to December, were down. In fact, the last increase year over year in inventories, you have to go all the way back to June of 2019. Let's take it a step further. Let's look at new listings in March. We had 6,061 new listings in the month of March. That was down year over year, 6.34%. February was up 11.21%. That's a strong indicator, actually, that we could have had a very, very strong spring market. In fact, there were a lot of sellers that the data bears out. They were waiting for this spring to put their home on the market. But unfortunately, COVID-19 hits, plans get altered, concerns arise, people stop thinking about selling their house and decide that they want to stand pat. January, down 9.9% year over year for new listings. December, down 13%, almost 14%. Here's something. When was the last increase that we saw outside of February? You have to go back to January of 2019. Yes, in fact, since 2016, we have only seen 2 months of inventories increase year over year. So what are we looking at in terms of the bottom line? Number one, people have more equity in their home. This isn't the early parts of the 2000s where people are pulling out equity from their homes left and right. There are restricting lending laws in place, and it's become harder to get a mortgage. Inventories are still at record or near record lows. And we do have sound economic indicators that are predicted to improve in the second half of this year when things open back up. So where are we right now? We are in a new normal. There are the elements of the things that we do not know and are unforeseen right now. We can't understand or can't necessarily understand or put on the calendar when our favorite restaurants are going to be able to open back up again. Nor can we predict when we're going to be able to go to a movie theater and enjoy a movie as a community experience. Nor do we know when we can go back to Fenway Park or TD Garden or potentially even to Patriot Place down in Foxborough and root on one of our local sports teams. We don't know when all that's going to happen, but we can't change any of that. Extra measures need to be taken, but there are still opportunities and there are signs that indicate that demand is still present. However, the lack of supply has not been able to meet that level of demand as of yet. This is still a seller's market, and all the data shows zero signs of that changing compared to previous economic crashes that became buyers' markets. There's a big difference there between where we are and where we have been in previous market cycles like this before. Therefore, we have to continue to work hard You have to educate your buyers and your sellers on what is happening and what the real expectations are there. Is it going to be harder to sell your home? Absolutely. Is it going to be harder to potentially get people to come see your home? Yes, but there are steps and actions that we can take to put in place to make sure that we are doing everything we can to bring all the buyers that we can to come look at your home and potentially get you the highest maximum price you can still get. Prices are still high. All the numbers bear that out. Median prices have gone up. Average price has gone up, but inventories remain low. Ignore the noise around you and pay close attention to your actions. Folks, you've heard Nick and I say this time and time again. It's so hard to not be paying attention to the world around you. And to a degree, you should always want to be paying attention to the world around you. But now is a time more than ever to focus in and control what you can control and stop worrying about what you can't control. What you can control is you can control the noise that you tune out and that you become more inward focused on what you're doing. Allow your actions that you're trying to do to take action in terms of growing your business and growing everything around you. Pay close attention to those things and allow those things to carry you forward. Hope this was helpful to some people. Hope people got some information out of this. Again, we are here to help. We are here to make you better in any and all way. We wanted to make this data driven. We wanted to be able to give you the most information that we possibly could in order to kind of allow people not to get so caught up on the negative world around them and the negativity that exists out there, that this is still an opportunity and there are opportunities that exist in this market as well.
That was incredible, Matt. Does anyone have any questions? We had, I thought I saw one of them in the chat box here. Steve Gilman, are the recent actions from banks like Wells Fargo and JP Morgan in suspending HELOC applications a sign of things to come?
I actually think that was incredibly smart from Wells Fargo and JP Morgan to do. From this, I know that came out this weekend, and I think that's actually an incredibly wise move. So people aren't putting themselves in a more negative position than they possibly could at this point in time. I think Wells Fargo in particular has caught a lot of slack for how they rolled that out. But I think the fact that they've paused all future home equity lines, I think that's actually a very smart move, basically saying we don't want to put anybody else in a more riskier position than they are. And I think people have also learned the lessons of 2005, 6, and 7, where people were just pulling their money out of their homes and on just ridiculous numbers to go ahead and pull out and just see what could be done. So I think it's actually a really smart move by those two companies. And I think you've actually seen Wall Street back that up today and what's happened with those two companies.
Awesome. I don't see any other questions in the chat box. So I know Anthony and Ron have been waiting patiently as well. If any of you guys have any questions, feel free to type them in the chat box for Matt. Matt can be responding while Anthony and Ron do their thing. Huge thank you to Matt for putting that presentation together. That was probably one of the best local stats and relevant presentations I've seen in a very long time. Nice work, Matt. Holy cow. Anthony and Ron, we appreciate you guys joining us as always. Oh, thank you. Someone just brought them on and unmuted them. Appreciate that. So if you guys, we appreciate it. And if you guys want to go forward with your update, that would be awesome. However we can help.
All right. Yeah. Thanks, Nick. And we just wanted to jump on here. We have a couple small updates. Unfortunately, we still have not received guidance regarding the loan forgiveness piece on this. At least full guidance, I should say. So we wanted to give an update of what we've found out over the past week since we last talked to the group. And then also maybe answer some questions or anything that people might have regarding the PPP loans. I saw a stat today. It looks like half of the appropriated funds for the PPP loan have been exhausted. In my guess, there's a lot of other banks that have loans in the queue that are just still waiting to be able to send those to the SBA. So my guess is it's only a matter of time quickly before those funds run out. So if you haven't got your PPP loan in, get that in now because you don't want to get to a point where there's no more money left and they don't do a part 3 to this thing because all the states are opening up and everyone thinks the economy is going to just turn on like a switch. So 2 things that we did find out over the past week. One is kind of not taxpayer friendly, is if you use the proceeds for deductible expenses, those expenses are no longer going to be, they're going to convert to non-deductible expenses. So for instance, if I'm an employer and I got a PPP loan and I'm paying the employees wages and I use those wages to get the PPP loan forgiven on a tax-free basis, those wages are going to now be non-deductible. Same with rent. Same with utilities. All the expenses that you use to offset the PPP loan so you don't have to repay it are going to be non-deductible in 2020. The one good area that I think is a win is for sole proprietors because of the concept of owner replacement. That's technically a drawer, and that's not an expense. So I still believe that Schedule C and sole proprietors, independent contractors, are still going to get the first $15,000 or up to $15,385 on a tax-free basis. But some of the funds that they use for rent and utilities, again, that's probably going to be non-deductible for your 2020 tax file in April of 2021. So that wasn't the best news that we got. Another aspect of the loan forgiveness is you're supposed to hire back the employees that you either let go or furloughed by June 30th. We still need some guidance on how that's going to be calculated, but the Treasury and the SBA put a new question up on their FAQs about, and this really relates to employers that have employees, to say, if I laid off my employees and then I go to hire them back because now I have a PPP loan, but the employees say, you know what, I don't really want to come back now because I'm doing better off with unemployment and the $600 increase from the government based on the CARES Act. When the employer goes to calculate their full-time equivalents, if they offer the employment and the employee says no, that does not reduce their full-time equivalents. Again, we're hoping to get more guidance on the loan forgiveness piece to really explain how this calculation is going to work. But essentially, the loan forgiveness is going to get reduced if you don't hire back the same amount of employees that you had before. You don't have to hire the same employees back, but the numbers are supposed to be the same. So this new FAQ that came out that says, because we're hearing it from a lot of employers that say, all right, we're going to hire these employees back. And these employees are saying, you know what, I don't really want to come back to work yet because I'm doing okay on unemployment right now. So I'll see you in July or August. And that's not going to hurt you from a standpoint of your full-time equivalent calculations if you offer it and the employee says no. Where it may hurt is that employee, if they get offered their employment back, they may no longer be able to collect unemployment from their state because, again, your employer offered you a position to come back to work. And if you say no to that position, my guess is most states will not allow you to collect unemployment under that scenario.
The FAQ also said you have to make the offer in good faith and it has to be written and the rejection by the employee has to be documented. So it may be an instance where you may have to keep some records if you are offering your employees full-time employment and they do reject it, as far as may want to keep notes on who the employee is, when you made the call. As far as a written offer of rehire, I don't know if you need to send them a letter or something along those lines. But again, I guess there's more. That'll be probably in the guidance that comes out in the interim final rule.
We had one question in the chat box, guys, about does the loan need to be declared as income if it is to be forgiven?
It's going to be included as tax exempt income from what we understand right now.
Cool.
Jumping back to, I mean, obviously the owner's compensation replacement, the max of the 15,000 and change is kind of, for lack of better terms, going to escape that forgiveness. As far as the rent and utilities, the other thing to keep in mind is that 75-25 rule. Something tells me there's going to be some more guidance perhaps on that, but you know, by the book right now, if your rent and utilities and your interest surpass 25% of the amount that you're asking for forgiveness on that loan, you're technically going to have a problem there. But the more I see, the more I envision the forgiveness being a headache, just because rents are high for some of these sole proprietors. And like you mentioned, I think the forgiveness is going to be, I think it's going to be very, very challenging for a lot of businesses, and I can't wait to see the guidance that comes out.
Do you guys have any idea when we can expect any of that guidance at all? I mean, it seems like it's constantly changing, and it's literally a leaky faucet right now, coming out drip by drip.
Yeah, again, we keep thinking it's any day now, but Secretary Munchkin was on Fox News, and he was mentioning that there's not a lot that they're going to be able to release because they need Congress to provide some more clarity, which didn't make sense because they made a lot of changes to the application and how to calculate the loan figures that really wasn't in the CARES Act. So I don't know why he says he can't make any adjustments to the forgiveness piece, but I think it's going to be a lot of politicking right now between Democrats and Republicans as far as what they want the loan forgiveness to look like. And hopefully, again, the frustrating part is we have a lot of clients who have gotten funded within probably the last 10 days, and we're going off of what we believe is going to be the guidance, but hopefully they give us enough time to be able to correct some of the decisions that we made if they end up being tweaked.
It seems like we were talking about this a couple of weeks ago, and we were talking about when you have gotten your funding and what you're putting that funding towards to document, and then document some more. Have you come across anything in particular or give any more guidance as to what people should be doing in terms of making sure that they're documenting how they're using the loans in the right way, or any sort of recommendations that you might have as you've seen more people who have now gotten the funding as to what they should be doing?
I think the first step, like I mentioned, I think we when it first came out, we had a discussion about making sure that you start off on the right foot by having those funds segregated and in their own account. You really don't want to co-mingle these funds with any of your other business funds. You really want to separate them to just make the paper trail and the tracing a little easier when you go to apply for forgiveness. I think it's going to be very important to have them in their own account, and then in either A, making sure that you're making the payments for the qualifying costs out of that account, or B, say for instance, you have all of your qualifying costs, your payroll, your rent, utilities, things of that nature, set up direct debit, or, coming out of your original checking account to make sure you're transferring the funds over from the PPP loan money to reimburse the business checking account. So I think, the first step is to make sure they're segregated and in their own account, if at all possible. And then step two is just to make sure that you understand the qualifying costs that are covered for forgiveness purposes. And then as time sensitive, as urgent as you can, making sure that when you do make those payments, if they aren't from the segregated funds, you're reimbursing your checking account for the qualifying costs.
Awesome.
I think, I mean, from my standpoint, there's three things at this point that I think are really important to understand for the group. Money is still available. There's clients that we have that are still getting funded and approved. I had one get approved this morning, so there's money still out there. The forgiveness piece is going to be challenging, so just do it. Document as much as you can. If you have questions, feel free to ask anyone the questions. You could certainly bounce it off me or Ron. And I think that at this point, if your application's in and you're kind of sitting in limbo and you're wondering what the status is and where you are in the process, I wouldn't hesitate to shop for the right relationship and the right bank. If your application's been in for a week or two and you haven't heard anything, you may want to try to ask around or perhaps go to another bank. I had a client last week bounce around a little bit just, because it was a big loan and they wanted to make sure they received it. We went to a new bank at the end of last week. They were approved this morning. So, you can't take out more than one loan, but you can certainly have more than one application. You just have to be careful. Once you are applied and approved for a loan, you have a loan number, you have to make sure you withdraw your other applications. So if you're like I mentioned, in limbo, I would try to shop around as best you can. And, some of these smaller banks with not so many applications may be the better way to go at this point.
Awesome. Nick, anything you want to add in?
I want to say as a tip to everybody that I want to say we had good luck with DCU. We did end up ultimately after 4 or 5 weeks of back and forth and revising Excel sheets to exactly where they wanted to see them. We did get funded on 2 of our 4 companies, which is good. And we were told that the other 2 were approved. That was on Friday of last week. So if that's encouraging to some people, I can connect you with the DCU rep. I know, a few people said that Eastern Bank did fund them, but I know a few other people who were upset with Eastern for different reasons as well. So those are 2 ones that I know of that were funding, and I guess 50-50 on whether or not we'd say they were the most glorious and easiest experience in the world. And the only other, so that helps people. Just to sum up to Anthony and Ron, what you guys had mentioned today, and for those of you watching, Anthony and Ron are with the accounting firm Restivo Monticelli out of Rhode Island. They concentrate in self-employment and business accounting, as well as real estate and commercial real estate syndications. They pretty much do it all out of their firm. What I heard today, and I was furiously taking down notes, was that number one, the PPP money that is coming in won't be, is considered tax exempt income, but the difference would be when you pay it out for payroll or for rent or for whatever you're using it for, it's not necessarily deductible anymore. But that's somewhat, just to break that down for people, like if you were deducting your payroll or your rent, typically like 35 cents on that dollar was deductible, right? Or it was like an actual dollar coming back to you tax time. So like free money is still better than deductible money, right?
Correct.
So, yeah, so that's good. So you can't deduct any of this money that you're using if you were funded from the PPP. And then I heard that you should definitely document if you offer the former employee back the position, but they reject it because they're getting that extra $600 a week on unemployment. You just want to make sure you specifically document that so it doesn't ding you when it comes time for the numbers of your employment, right? On the PPP
Correct.
aspect.
Yes, at this point, yep.
And I heard, I'm sorry, you said something about a 15K owner replacement. Was that the same thing there? So if they don't come back, what was that one?
So the 15K is the owner's compensation replacement, quote unquote. So for instance, if you have a Schedule C that you report your business activity on, you're capped at the 100,000 for your PPP loan. If that's how you report your business for tax purposes. And as far as forgiveness is concerned, you're eligible for, 8 out of 52 weeks, that percentage of owner's compensation replacement, just because a lot of self-employed individuals, take a draw out of the business. And it's pretty much, a a one-man show or a one-woman show, so to speak. So 8 out of 52 weeks, the 8 weeks is the forgiveness, the covered period, is eligible for forgiveness right off the bat as owner's compensation replacement. So the 8 out of 52, that percentage, times the 100,000 cap is roughly 15,000 and change. So that's the amount that's eligible for forgiveness for the self-employed individuals.
And that is, I want to tell most of the real estate agents, 1099 contractors, vendors, stagers, agents. I mean, folks, depending on what you submitted, there's your number right there, right? So, I mean, if you were making 100,000 a year, which you had to substantiate, if you're making $50,000 a year, it's half of that amount. Mm-hmm. So that would be the money that you would be able to pay yourself during these next 8 weeks and have it forgiven if you have the correct documentation. That's accurate, Anthony and Ron?
Correct.
Yeah. With the limited guidelines and documentation coming out from the SBA, that's the information.
pretty confident on that one though. That was pretty clear in the interim guidance that came out for self-employed individuals.
Awesome. Anything else, guys, that you want to add for this week's update?
No, it's been a slow week as far as guidance coming out. I mean, we're waiting for it. If you're looking at Fox News or CNN, there's always a congressman on there talking about the guidance coming out, but it still actually hasn't come out for us to analyze. So that's going to be the biggest piece that we're missing right now is the guidance on the loan forgiveness part.
Gotcha. Excellent. Heidi just mentioned Enterprise Bank was very good. She was approved there. And Melissa Darling, if we are interested, we get new people every week on these, Ron and Anthony. So this is Melissa saying, if we're interested in talking to Anthony and Ron, how do we get in touch with them?
I mean, you could certainly send us an email with any specific questions or with any follow-ups. I know our emails have been in some of the other slide decks that we have in the archive, if you will, for the presentation. But I can. Do you want us to drop our emails in that chat, Matt?
Yeah, I just did that, Anthony.
Yeah, if you wouldn't mind just dropping it right there in the chat, I think that's probably going to be easiest for you guys. Thanks, Ron. Okay.
Awesome. Well, once again, Ron and Anthony, thank you for devoting your time. I know you're extremely busy, so this hour that you devote every single week is huge. For those of you enjoying this chat, I mean, they just dropped their emails in there. Feel free to reach out to them. And if you guys are looking to start a new CPA relationship, I'd highly recommend their firm. They've been awesome to work with. We use them for all of our stuff too. Anthony and Ron, guys, thank you again so much this week. And do you think, can we get you next week too?
Yeah, we're hoping we have the forgiveness and we'll have a lot more to talk about. We came on today, we were just like, oh, we only have a couple things to talk about. So once we get that loan forgiveness piece, we'll probably have a good half hour of presentation to give you guys.
Fantastic. All right then. Matt, anything in closing?
No, I appreciate Ron and Anthony as always.
You guys are awesome. And to everyone, thank you guys so much for another 3 o'clock next Monday. We'll be here 3 to 4 o'clock again, potentially 3 to 4:15. If we have more information on the 1099 loans programs and the CARES Act in general too. That's the other thing, Anthony and Ron, if you guys just want to highlight any other aspects too, if there's something going on PPP wise, feel free, Okay. And folks, that's it. If you guys want copies of Matt's presentation, Matt, are you willing to share? I guess this will all be on the AA Real Estate group.
Well, I'll make sure that we get this over to the right people on the team to get this distributed out to everybody.
Fantastic. And thanks in advance to Miss Brianna, who's also on this for doing all the hard work on getting these prepared, set up, and then put out. So thanks everybody for another huge week, a week of clarity. Let's go out and hit it one more time. Quarantine 2020. I can't end it, Matt. I was hoping to end it right there dramatically, but I couldn't end it. You have to do it.
Have a good day. Have a good day, everybody. Be safe, be smart, and we'll look forward to talking to you guys next week. All right?